Bismillahirrahmanirrahim. So today we are going to study prospect theory, and how it applies to real world situations. So before I begin, let me just say that there is the standard economics, which is based on expected utility theory. It's an axiomatic approach, so it assumes in advance that we know how human peoples behave, and so it never checks to see actual behavior. So prospect theory is one step ahead of that. It looks at actual behavior and tries to pick out the patterns. So it describes systematically how people behave when they are making decisions under uncertainty. But it is not at the third level, which is that we try to understand how people behave. So we look at how people behave, and then we try to find the reasons for this behavior, because this behavior is not, according to economic theorists, rational. So people look at magnify small probabilities, and they make many other adjustments to what is supposed to be rational behavior. So for you can say that it is not rational, but basically the issue is that what is it? What causes this behavior? So understanding behavior is one step ahead, but prospect theory is a step in the right direction, in the sense that it actually describes what is really seen instead of some assumption about human behavior. So we are going to discuss today this paper by Colin Camerer called Prospect Theory in the Wild, in which he basically discusses 10 examples of real world situations where the conventional economic theory fails to describe what happens, and prospect theory provides a better match and gives us some understanding of what is really happening. So the slides I am using reference the Kahneman Nobel lecture in 2004, in which he talks about prospect theory. Basically, Kahneman was a psychologist. He started studying human behavior, and he found that it doesn't match the assumptions about human behavior that economics made. So then he came up with this prospect theory, which is a better description of what actually people do. So some of the insights that we get from studying actual behavior is that changes are salient and maintained states are ignored. So basically, when people are making decisions, they look at the change that will happen as a result of this decision. They don't look at the overall. So economic theory assumes that you look at the net picture, the final result, and that's what you will get in the end. But actually what people look at is the change from the current position. So that means that there is a reference point effect. The amount of wealth you start with, that matters, and then that creates the benchmark, and then you look at losses and gains differently. So framing outcomes in terms of wealth is psychologically unrealistic but normatively appropriate. So if you look at the total wealth, which is what economists do, that's how is psychologically unrealistic. That's not how people behave, although that is how they should behave normatively. That's what makes sense. That's what's rational. But that's not how actually people behave. So indifference curves have kinks, in the sense that status quo is strongly preferred. So when you are moving away from it, then that's different. So prospect theory, what does it add to the decision making? Well, Kahneman and Tversky introduced the value function. So instead of utilities, they look at values, and the carrier of value is the change in wealth rather than the final state. So this is again difference from standard economic theory. So when you come to applying prospect theory to a real world situation, first you find out what is the reference point where you are, and then you look at how much change will be occur as a result of the prospect. So this is a theory of decision making under uncertainty. So different types of things might be happening. So you're looking at whether the change will be positive or negative because you react differently to these types of things. So the property is the value function is a concave function, which means that it has diminishing marginal value. So if you have a temperature change from 3 degrees to 6 degrees, that's a doubling, but from 13 degrees to 16 degrees is not that much. And a gain of from 100 euros to 200 euros is a large gain, but from 1100 euros to 1200 it's a small gain. So it's the same gain of 100 according to standard economic theory. You will evaluate it the same, but it's not. That's not how it works psychologically. And similarly for losses. So now the thing is that people evaluate losses and gains differently. That the loss function or the value function is concave. We will see what that means for gains, but convex for losses. And the marginal value of gains and losses decreases with the magnitude. So here are the two axes, and at the intersection we have the reference point, which is where you currently at, 0, 0. So your currently you have neither gain nor loss, and your value is 0. So the value function, the gains are measured on the right side and the losses are measured on the left side. And this is the value function for gains. So for small gains it's sharply increasing, but as the gains become larger, the value function becomes flat. So when you're calculating the results of getting $1 million or $2 million, the difference is not that much. But if you're calculating for $500 and $1,000, that's a big difference. Even though going from $1 million to $2 million is a huge difference, but psychologically it's not. Now in the loss function, when you come to loss, then the function looks rather different, and it's very steeply declining. So people don't want to lose anything, and there's a very strong psychological aversion to losses. So losses are treated very differently from gains. So this picture shows that for an equal amount of gain and equal amount of loss, the loss seems much larger and the gain seems much smaller. So the value function is defined on deviations from the reference point. The reference point may be the status quo, or it may be individual's endowment. Now the interesting thing is that this reference point changes from time to time. So this creates a certain kind of a bias. So if you ask people how much you would buy this, there's a famous experiment with mugs in which if you give the people mugs, then they value it much more highly because it's part of their endowment. They don't want to lose it, so the price they ask for selling the mug is very high. But when you ask them to buy the mug when they don't have it, the price is very low. So now, in prospect theory, instead of multiplying the outcome by the probability of outcome, you multiply the outcome by the decision weight. So generally speaking, if something has very low probability, it generally if you take it into account, then you make it have very high weight. So a very small probability. There are two things will happen. Either people will say that this is a small probability, like 1 in 1,000, so completely ignore it, set it to 0, or if they take it into account, then they magnify it, exaggerate it, because so people are limited in their. So both of these things can happen. Highly unlikely events can be either ignored or they can be overweighted. And similarly, either if you have a high probability event like 80% probability, people will either say that this is almost certain, or they will exaggerate the difference. So people don't behave very rationally with respect to probability. So this is what prospect theory builds into the decision. So prospect theory is trying to describe how people actually behave, not a rational theory of behavior. So this is the actual probability, the red line. But the perceived probability is sort of like this. So for low probabilities it's overweighted, for high probabilities it's underweighted, except near the end where things go strange. And actually in the original paper they left the last parts blank to show that we don't know what will happen here. So this is the weighting function, which is shows the perceived probability, which is different from the actual probability. Now economists have a real tough time with this, because to systematically miscalculate probability is irrational. I mean, it can happen from time to time. That's not a problem, that people can make mistakes. But to systematically all people behave like this, generally this is a serious problem, because it means that people are not behaving rationally. And that's why prospect theory has not been accepted very widely, and you won't see it much in textbook. Are always teaching expected utility theory as the standard theory of decision making under uncertainty. But this is the real behavior of people. So this is just to illustrate people were asked about what are the chances of death from heart disease. So this is fairly high, but people estimated it to be much lower. And then when you go to small low probability events, so then what is the probability of death from fireworks? So people estimate it to be very high, when in fact it's quite low. So this is just to illustrate how the prospect theory describes behavior. So they did a survey of people and asked, what are the chances of your dying from fireworks? And so the dots show the pattern that the previous graph showed, that the low probability events are high weighted and the high probability events are underestimated. This is systematic bias in understanding or calculating from probability. This is another illustration of the same phenomena, that the probability of death from high probability events is underweighted and low probability events are overweighted. So Colin Camerer starts by this theory. His prospect theory in the wild is the paper, and it's on your website. And basically he says, okay, instead of doing prospect theory in experiments, which is where it was invented, let's look at real world events and see if this theory can be applied to real world situations. So he looks at 10 anomalies in naturally occurring data. So he looks at 10 things which happen in the real world which cannot be explained by conventional economic theory, but they can be explained by prospect theory. So basically the anomalies for EUT, expected utility theory, because expected utility theory says this should not happen. But if you look at prospect theory, then it says that yes, this is the normal behavior. So there are basically 3 simple elements of prospect theory which are used in this paper. One of them is called loss aversion, which means that people don't like to lose, so negative changes in income are very strongly prevented. There is the reflection effect. Reflection effect says that basically if you look at something, a gamble in gains, then the reverse thing happens when you do when you look at losses. So the losses are reflection of gains. So things don't happen. So we explained that if you have a choice between a gain of 0 and a gain of 100, and you are offered $50 in, then people show risk aversion. People will take the $50, they will not take the gamble. But in the reverse, when you look at a loss of $100 and a loss of 0, and people are offered a certain loss of $50, so people will not take the certain loss of $50. They will say that let's take a chance, maybe I won't lose anything. So again, this is not understandable according to expected utility theory, but it is prospect theory. And then there is this non-linear weighting of probability, that instead of looking at actual probabilities, people misestimate the probabilities. So the certain events, the high probability events, are not given as much weight as they really have, and low probabilities events are overweighted. And then the fourth aspect, which was not discussed earlier, is that how people frame the problem matters. And very often people will break up a problem into small pieces and consider each piece separately instead of considering all of them together. And that's technical name is called narrow framing. So you take decisions one day at a time instead of considering the overall effect of the decisions. So basically in economic theory you are told that people maximize lifetime consumption. So you look at this year's consumption and next year's and throughout the life, and then you maximize that. So then what would happen as a result is that if you are thinking that your income will go up next year, you will actually save this year because you will borrow some of that. And if you are thinking about the possibility that there will be a large income loss next year, then you will reduce your consumption this year. But in reality this does not happen. People take 1 year at a time, and we will see that. So people isolate decisions from the others, and they make decisions in separation. So there is a famous puzzle in finance which is called the equity premium puzzle. So the result is that basically, the people have a choice in investing. They can go into bonds which offer a certain rate of return. It could be like at the time that this was written, the paper by Mehra and Prescott, the bank returns were around 3%, and that was also what the treasury bonds were returning. So that's a certain return, and stock market returns were around 10%. So that's a huge difference. So then there is a question that if you can get 8% return in stocks and only 3% in your bank account, then why do people invest in banks at all? And there were many possibilities that were raised, like, there is a lot of risk in stocks, but there are answers to these issues. For example, there were mutual funds which would buy a huge number of stocks. So people can buy stock inside a mutual fund. So that way, and it was one of the explanations given was that if a person invests in one stock, that will be very risky. So you can buy a lot of stocks at once by buying a mutual fund. And when you buy a lot of stocks, then the individual variation of stocks is reduced, and you only have the risk of the stock market as a whole, which is much less variable, but still it has a lot of fluctuation. So Mehra and Prescott in 1985 said, all right, stock market is variable, so you have a risky return, and bonds are not risky. So let us think about what is the degree, and people are taking 3% return over 11% return. So how much risk aversion is required in order for people to do this, in order for people to prefer the certain return, using standard expected utility theory? So there are some calculations, which I won't go through, of what is the risk aversion. So basically they did the calculations and they found that suppose that you offer a person a bet in which one option is $50,000 with 50% probability, and the other option is $100,000 with 50% probability. So now a neutral person will want $75,000 in return for that, right? And a risk-loving person will be willing to take less. So if you are offered this gamble and somebody says, how much certainty what is the certain amount of cash that you would like, that you would prefer instead of this gamble? So if somebody takes a 3% return instead of a certain return, instead of an 11% uncertain return on the stocks, then his risk aversion level is such that he will accept $51,300. So only $1,329 is what he needs to give up getting a 50% chance of $50,000. So that's enormous. So this is what led to what is called the equity premium puzzle. That why people are not that risk averse. We know that. So if you offer a person $50,000 and $100,000, he will not take $51,400 as a certain cash. He would rather have more chances. He's getting $50,000 anyway, so an additional, instead of getting an additional $1,000 certain, he would rather go for the 50% chance of getting $50,000. Now, if you offered him $25,000 extra, he would say, yes, I will accept the $75,000 certain rather than gambling for. So, the level of risk aversion required to explain why people put their money in banks when the stock market is offering 8% more return is not explainable according to expected utility theory, because the risk aversion required for this is too high. So here is a table of the returns which shows how this puzzle works. Basically, in 1802 to 1998, over the entire period, the 20th century basically, two centuries, 19th century, the market return was around 7%, and a riskless security was offering 3%, so there was a 4% premium. Over basically the 20th century, the market return was around 8%, and the riskless return was around 1%, so there was a 7% return. From 1926, notice this includes the Great Depression, in which there was a huge stock market crash. Despite that crash, and including that crash inside the picture, we have 8.7% return on the market and only 0.7% return on riskless securities. So 8% risk premium, which is what they calculated, Prescott and Mehra. From in the last half of the 20th century, the return has been 8.4% to stocks and 0.6%, 7.8% risk premium. So this is huge. So, and this is the same phenomena you see in all countries. In UK, 4.6%, this is called the equity premium. Japan, the equity premium has been 3.3, which is low but pretty high still. 6.6 in Germany, 6.3 in France. So stocks pay a huge return, but in the long run, but people nonetheless, the amount of investment in stocks is very low relative to the amount of money that is in the banks earning us sure return. So why is this? Previously, before the Scott and Mehra, people just said, yes, that's because people are risk averse. But what they showed is that if you calculate how risk averse they are, you find that this is not compatible with what we observe about people's behavior. People are not that risk averse as required. So that created the equity premium puzzle, and there's a huge literature on this. Why? So, but none of it gets to the answer, which only the prospect theory, because the reason that the literature doesn't find an answer is because they are committed to rationality. So once you say that people are rational, then this is a real puzzle. Why is a rational person overlooking such a great gain? There must be something, and so people have tried to find out what that something is, but have been unsuccessful in the framework of expected utility theory. So here, what Colin Camerer is telling us, that if we abandon prospect theory, if we abandon the rational behavior, then we can explain this. Unfortunately, because of the you can see it. The if you want to look at it another way, if somebody put $1 into bonds, and in 1926, just before the Great Depression, and then in 2000 he cashed it, he would have about less than $600. But if he put it into stocks, he would have $7 million. So in one case he would have 600,000, in the other case he would have 7 million. This again shows what a huge difference there is, and why this should override any risk aversion factors. There should not be such a big difference. I mean, sure, risk aversion can explain that if you had double or triple or 5 times or 10 times, but not 1,000 times. And this is what we are having, is that people are taking 1,000 times less because so risk aversion is not enough to explain this. So then the question is why? This is a picture of the same thing basically. If you invest $100 in 1927, the orange line shows what you would have in 2012, which is around $10,000. But if the blue line, this is a logarithmic scale, which is why the huge numbers are so, but the blue line shows that you would have $100,000. So if you put that $100 into stocks. And the gray line is what would happen if you did a 50-50 mix, 50% bonds and 50% stocks. So even the 50-50, which is fairly much safer strategy, gives you a huge return relative to, but most people don't have any money in stocks. So again, this creates the equity premium puzzle. Now, if you look at the year-on-year returns in 2 places, one is the stock Standard & Poor 500. So the blue line shows that it's very random. So now, so on a year-to-year basis, the stocks are very risky. But it's the long run that the stocks are a sure shot. If you look at the treasury return, 10-year treasury bonds, then that is much less risky relative to the stocks. Although after 1985, this treasury also becomes quite erratic. So in 1997, Bernardi and Thaler, the one who won the Nobel Prize recently, wrote a paper which explained this for the first time in a satisfactory way. And they said that basically this is due to two things we learned from prospect theory, which are not part of standard utility theory. One is loss aversion. So people don't like to lose much more than they like to win. So if you offer a person a chance in which he will lose $100 with 50% probability and he will gain 100, he will not accept that. People do their best to avoid losses, and in avoiding losses, if they forgo gains, that's not a big deal. So, but this by itself does not explain the equity premium puzzle. The second part is narrow framing. So people look at things 1 year at a time rather than over the long run. So if you look at 1 year at a time and you take into account loss aversion, then the decisions that people make are compatible with rational behavior, in the sense that the risk aversion for 1 year is quite high, and if people are especially interested in not having any losses regardless of what, then they will not invest in stocks, because the stocks, there is always a chance of loss. So the high return that stocks earn compensates people for the much higher chance of losing money in a single year. So they calculate that they put a loss aversion coefficient, which is a prospect theory term, not a standard utility. That when you for a small loss, you count it as 2.2 0.25 times the utility of an equal gain. So a $100 loss is counted like a $225 loss. So now if you take this and you take the second assumption that people are only thinking in 1 year intervals, then the prospect value of stock and bond are about the same if the stocks return 8% more. So now the prospect theory explains the equity premium puzzle, in the sense that 8% is compatible with reasonable values for human behavior that we see. So that is one of the puzzles that is solved by a prospect theory, which is not solved by expected utility theory. The second puzzle is called the disposition effect. So basically Camerer is going through many things that we see in the real world which expected utility theory cannot explain, but which are explained by prospect theory. And as I have said previously, prospect theory is not really an explanation of why this happens. So then the question remains, why do people think 1 year at a time instead of thinking of 10-year horizons? What they should do is they should put money in the stocks and forget about it. 10 years later we should take it out, if you have that. So why do they think that? That's a question that prospect theory does not handle. Prospect theory is a theory which describes actual human behavior, and in that sense it's much of an improvement over expected utility theory, which is a normative theory. This is how people should behave. So when people don't behave like that, then you are stuck with nothing. So prospect theory describes how people do behave, but understanding lies at a further level, that why do people behave like that? That is also being explored, but currently we are just looking at prospect theory. So there is the disposition effect. If stocks rise in value, people sell them and cash the gain. So there is a very well-known term in stock market that now people are cashing in their gains. People are taking their returns, and they do not, and they hold on to stock which has lost value. Now the thing that this makes is that the reason that this is wrong is that the value of stock shouldn't have to do with what its value was when you purchased it. See, the value of the stock should be, whether you decide to sell or whether you decide to buy depends on what you think will happen to this stock. If the stock is going to rise, you should hold it. If the stock is going to fall, you should sell. Whether you purchased it at a high price or whether you purchased it at a low price shouldn't have anything to do with whether or not you are selling according to the theory of rational behavior. Is that clear? Because what happened when you purchase it, it's all in the past. It's irrelevant to your decision. The only thing that matters is the stock going to rise? Then you should hold it because you'll make profits. Is the stock going to fall? Then you should sell it because you're going to make losses. But this is not how people behave. So, paper by Odeon, he found that investors hold losing stocks for 124 days, and they held winners for 104 days. So there's a tendency to cash winners quickly and to hold on to losers. Now, the immediate response of expected utility theorists will be that if people are selling winners quickly, it is because very likely they know that these winners are going to go down. They are winners up till now, but they are about to go down. People are rational. They can foresee that this thing is about to go down, so I should sell it. So that is the standard explanation that would be given by expected utility theory. But look at what happened to these stocks which were sold. So the losers earned 5% in the subsequent year, which means that they did badly, so they should have been sold sooner. The winners did tremendously well. They got 11% in the subsequent year, so they should have been held because they were doing well in the future. So according to the rational expectations theory, which is the theory of Fama, which won the Nobel Prize, the people should have held the winners and they should have disposed of the losers, but they did not. So what is the explanation for this? So again, what we have to do is look at reality of human behavior as opposed to a normative theory of how people should behave. So this particular issue is explained by taking the base value, which shouldn't have mattered, as the point at which you purchased. So now there is the realization utility. So you purchase a stock at $100. Currently it's trading at 80. So according to standard economic theory, you have lost $20, but psychologically you have not lost anything. You realize that loss when you sell the stock. So if you take into account this realization, so economic theory, once it's $80, whether it's $80 in stocks or $80 in cash, it's all equivalent. So your selling the stock should not does not depend on what the value of the stock was 1 year ago when you purchased it. But psychologically, it's not like that. Psychologically, when you sell the stock, then you either realize a gain or you realize a loss. So when you realize a loss, that's a big hit. Loss aversion, remember, 2.5. So if it's $20 down, you think that you're going to lose like 400, and 2.25. But also you take pleasure from realizing gains. So even the stock has gone up, it's 100, but it's now 120. You will realize the gain if you sell it. Otherwise, it's just the worth the same $100 that it was when you purchased it. The value is just a number in the air, which is on the stock market. But until you sell and realize the cash in your hand, you don't get the utility from the gain. So the psychological behavior is different from the rational behavior. So if you take into account this realization utility, then you have this kind of situation where the current price, the purchase price is at the origin, 0, 0. That's what the person is taking as his reference point. So now if there is a gain, then you see that's discounted because you have a convex utility. The same amount in loss is a much bigger value of loss because you have steep decline. So now you see, if you have lost L and you are thinking it might go down to 2L, well, from your reference point, the loss from between L and 2L is not that high. I've already lost so much in this stock. If I lose another 100, what does it matter? As opposed to thinking that I'm going to lose another, and if you lost $1,000 in the stock, now if you hold it, you will lose another $1,000. But there is a small chance that it might recover. So now, in order to avoid loss, you take that small chance, and on the other hand, there is the risk that it will go to 2,000. But the loss of $1,000 and loss of $2,000, these two are not that much different. So you say, okay, let's make it take a chance. Let me hold on to this. Maybe it will recover, because you don't want to lose. Psychologically. On the other hand, on gains, it doesn't work like that. the value of so I have gained $1,000, and if I hold on to this, I might gain 2,000. Well, the additional $1,000 is not that important. If I cash it now, I can realize a big gain. So this is the explanation of from the realization utility, which is a psychological phenomena. It is not a economic phenomena, because from economics point of view, all of these things are the same. Whether you're holding stocks or cash, it's the same. So this explains how prospect theory explains behavior, while expected utility theory does not. Okay, there is another third phenomena. It's a very interesting phenomena that Camerer and four talkers there is a theoretical reason why they looked into this. They wanted to learn about labor supply behavior. So now they interviewed a lot of taxi drivers in New York City about how you decide to quit. So what the drivers do is they set up an income target for that day, and when they achieve that income, then they quit. So now it turns out that in New York there are different types of days. Some days there is a big show in town and lots of people are taking taxis. Some days the business is slow. So there is a standard discrepancy. So now what happens is that they work long hours on bad days because they have to make up their amount, and on good days they quit early. Now what the standard theory of labor says is that if you are offered a higher wage, you should work more, and if you are offered a lower wage, you should work less. But exactly the opposite is being done. And okay, so that's it. This is the puzzle. Now this is a real puzzle in the sense that how the taxi drivers behave is not rational, in the sense that if you look at the earnings over the long period, what they should do is they should work all day when the return is high, and they should quit early when the return is low, because today is not a good day, you're not going to get too much, so you should enjoy leisure on that day, and on the days that you're earning a lot, you should keep on working. So again, this is due to loss aversion and narrow framing. People think one day at a time. Actually, they calculated in the article the elasticity of substitution. You see how much your income tomorrow should be able to substitute for your income today. So over a period of time. So they find that if people are experienced, then they do less of this, and they understand that they should quit early on low pay days, and they should work harder on the days when you are quickly getting lots of rides and making more per hour. But inexperienced drivers don't. So this is the fourth puzzle, which is explained by prospect theory and not explained by expected utility. Sorry, that was the third. This is the fourth. So when you calculate price elasticities of consumer goods, then it turns out that the calculations are not being done correctly, because they don't take into account the reference effect. The standard economic theory calculations of price elasticities are not based on the idea that people are loss averse. But if you do that calculation, then the price elasticity for a price increase will be different from a price elasticity for a price decrease. So if you mix both of those two up, then you will get the wrong results. So they look at this, and they analyze consumer behavior and sales. So they find exactly what they expect, that if price increases, then people respond to it more by shifting away from it, because it's a loss to them. And the response to a price decrease is not as strong, because that's a gain. So the gains are discounted and the losses are magnified. So if somebody calculates elasticity from making a small 10-cent increase, then he will see a large elasticity, and he says, okay, if the elasticity is this high, if I make a small cut in prices, people will buy a lot more. Then he will not get that result, because the elasticity to a cut is not the same as elasticity to an increase. And so asymmetric price elasticity is observed in the real data. And again, this cannot be explained by standard utility theory. So one paper estimates this effect, and he finds that consumers get more utility from buying when prices have risen than the extra utility they get from when prices have fallen. And the loss aversion coefficient is 2.4, which is the same coefficient as we see. So if you increase prices by 50 cents, consumers view it as a price increase of $1 and 20 cents. I mean, that is how much impact occurs on the sales. If you decrease prices by 50 cents, it's just like 50 cents. I mean, this is the framework. So the elasticities are different for cuts and for losses. All right, this is the famous life cycle hypothesis, that people will smooth earnings. But in fact, this doesn't happen when you look at real behavior. See, this is the problem with economic theory. They make these theories and this is how people behave. They never check what people really do. So now, what people do is they spend a fixed fraction of the current income, and they don't change this across the life cycle. As a result, what happens is that after retirement, consumption falls very steeply. Now, people who have studied this, they find that this is not their optimal behavior. If you counsel people properly, you have to. I mean, people don't worry about retirement. They say we'll take things when we get there. If they are made aware of the problems, they are shown that okay, so and so after he retired he fell into difficulty because he couldn't, then they will make the decisions, and it is possible for them to change their savings to improve their retirement income, and that would be the wise choice for them to make, because afterwards they regret and they say that I should have saved more. But this is a standard problem, that people don't do the lifetime cycle calculations that economists think that they will. So as a result, it is very important to provide retirement counseling to people, because they are not making lifetime maximization decisions. So they made a prospect theory model which explains actual behavior. In fact, when people anticipate that next year there is going to be, I might be out of work, you would expect them to save money to provide for that. But no, they don't do that, because they discount the probability of low events, and they are loss averse. They don't want to take the loss now in order to prevent the gain, in order to have a gain in the future. So the psychological behavior of people is rather different from the one that optimal behavior theory suggests. So similarly, if there is good news about the future, that they will get a raise, they don't actually utilize it in the optimal manner. So they will not count on it. So again, the actual behavior differs from the behavior predicted by utility theory. Prospect theory predicts that behavior more accurately. So when you start studying real behavior, you find that there are deviations from expected utility theory, and the prospect theory provides a better match to that behavior. And in some sense, the prospect theory is something which we can understand because it is psychologically, we can understand it as a manifestation. But prospect theory itself doesn't provide the psychology; it just provides a description. Okay, there is a standard status quo bias, which is also called endowment effect, or the gap between the buying price and the selling price. So there are many such cases that Harvard University added a new health care plan. Now, assuming that the new recruits who come into the university, they choose between these two plans. So assuming that the preferences are the same of the people, then the proportion of people on the new plan and the old plan should be the same. But it doesn't happen. The old faculty who had the old plan stayed on their old plan, just inertia. They didn't investigate. Whereas the new faculty prefer the new plan much more because they get to look at both and they make a choice. There are many similar examples. In Pennsylvania and New Jersey, they made two different types of insurance policies. In the two states, there was a different default option. And if you don't make a choice, you are assigned to a certain type of policy. So whatever the default was, the people were on that default. So most people don't make. This is exactly the opposite of the maximization behavior, where people look at all options and calculate the consequences and then make the optimal choices. People just take whatever is offered. So this is the standard. So actually, when similar studies of the endowment effect, when you have something, then you prefer to hold on to it and not make any changes. There's a study about restaurants that if you put a big menu of choices, the item at the eye level is chosen most often because that's the first thing that people see. So they don't look at all the choices. There's something called the endowment effect. This was an in-class experiment which was run with coffee mugs. You can actually do this in your experimental class. This is not difficult to run because coffee mugs are cheap. So some people are randomly chosen and are given coffee mugs, and they are asked, how much would you sell these for? So suppose that these mugs cost 100 rupees to purchase in the market. So once people are given these, okay, here, this is your gift. Now they have these. Now they ask, how much will you sell these for? And they might be told that the price of this mug. They'll say, I'll take 200 rupees or 300. So other people in the class are asked, well, I have these mugs. How much will you pay for them? So they will pay very little to buy. They'll say, I have 50 rupees, 75 rupees. So why is this person asking, yani, if there is a value of this mug, he just got this as a gift, and if he is willing to pay only 50 rupees or 75 rupees, then he should be willing to sell this for 100 rupees. So this is called the endowment effect. Once you have it, then this becomes part of your reference point. So now giving it up is a loss. So being compensated for this loss, you ask for much more. And on the other hand, now to buy a mug, this is not no longer part of your reference. So buying, you don't value that mug too much. So endowment effect is when you have something, then you don't want to lose it. So this is one major reason why house sales become very difficult in times when the house prices are declining. There are many papers on this because this contradicts so much the economic theory that economists try to explain this in many different ways, and there are many papers are written, but ultimately the psychological aspects are more important. So in the housing market, when the prices decline, the people who own the house, they say, I bought this at 100,000, I'm not going to sell this for 80,000. Even though the value of the house is now 80,000, yani because the market has declined. So psychologically, people don't sell houses in such markets, even though they should, in the sense of rational behavior.
Is it because they're sentimental to it?
Yes, because of sentimental effects. They own the house. The value of the house is worth more to them than the market value. Now there is a seventh effect, is the long short bias. So when people are betting on horses, is that they bet on horses which are offering 20 to 1 odds because they are losers, and they don't bet on the sure shots, the one that is offering the one that is high win. Now in pari mutual betting, you see what happens is that the people can bet on different horses according to however they think, but the odds are determined by the amount of money being placed on the bet. So basically what the racetrack does is it takes all of the money that has been bet, and then it takes 10%, it's cut, and then whatever is left it distributes to the players according to how much was bet in different horses. So for example, there are only 2 horses. One is the favorite to win, so $1,000 is bet on the favorite. The other one is underdog, so $100. So then basically the is bet on the other horse, which is very likely to lose. So then the other horse will pay you 10 to 1, except for the cut that has been taken, and the favorite will pay only 10%. So this is how the so now it turns out that if you look at prospect theory, it predicts that the favorites will be underbet and the long shots will be bet more upon. So people will like that 10 to 1 bet. Now if you can win 10% sure, so and so what happens really is that, and if you are in this situation, which you should not be, then the place to bet, the one which will win, is the favorites bet, the one which is sure shot, because less people are betting on the favorite and more people are taking wild shots in the hope that they will win large amounts, even though the chances are not there, because the low probability is overvalued and the high probability is undervalued. So this means that and you can analyze that the people who are betting on favorites make more in expected value terms, and the people who are betting on the long shots make less in expected value terms. But psychologically, this is how it works. So there are some explanations that are given for the long shot and the prospect theory is the overweighting of the low probabilities of winning. There is also the gambler's fallacy that favorites have been winning a long time, so now it is time for an underdog to win. And the third comes from regret, that if you bet on a favorite, you're only going to gain about 10%, and if he loses, then you will have such a huge regret that why didn't I bet on the favorite which was going to, the underdog which was going to give me 10 to 1 returns. So whenever you think that there is somebody else and something else has a chance, then you don't want to miss that chance. So suppose that there is a underdog and he has only a 10 to 1, and you have a feeling that maybe this time this one will win, and on the other hand you know that the winner is going to win. So if you bet on the winner, you will make a small amount and you will go home without any. But if the long shot comes in, you will have such huge regret that, oh, I was thinking he might win, I should have bet, and then, so avoid this regret, you bet on the long shot.
If you bet like $10, it's going to be only $1.
Yeah, $1 gain for the $10.
If you're going to be like betting the
long shot, you can get 10 to 1, yes. So in state lotteries you have similar kind of phenomena, that basically what happens is that people choose 6 different numbers, and if all of the choices match, then they win the jackpot. If none of the people choose the right, then the jackpot is added to the next one, and then jackpot increases. So the phenomena they find is that ticket sales are correlated with the size of the population, and that is correlated with the jackpot size. So as the jackpot size increases, more people buy. Now, the reason that this is a puzzle is because the probability of winning remains the same. So why should more people buy? I mean, in the sense that, well, of course the jackpot size is important, but basically the response is not as is more than is predicted by expected utility theory. And the reason for that is that the people don't calculate accurately the low probabilities. They're all a blur. So there's 2 things. There's a low probability event and then there's jackpot. So they only look at the jackpot. Oh, there's a double chance of winning. Halanke, the chances are the same. So if you take the jackpot and multiply that by the probability of winning, it would be negligible. But you only look at the jackpot, you don't look at the probability, some probability of winning. So then you don't have, then you don't get discouraged. So basically, in order to understand human behavior, we have to look at real behavior. And the next conclusion, which is very important, is that this is how we behave. And we don't behave rationally. So that means that we can improve our decision making by taking into account. And this is actually today the frontline research is being done. How we can think about our own behavior and improve our own behavior, given that these biases are inside our brain. This is how we act. So this is the paper ends by examining 10 ways that we get it wrong. So, for example, we fear snakes and not cars. The chances of getting bit by a snake is very low. Chances of getting run over by a car is very high. We fear spectacular, unlikely events. Now, the probability of getting killed by a Muslim terrorist in USA is less than the probability of getting struck by lightning and dying. But trillions of dollars are being spent on fighting Islamic terrorism. Well, there are some other reasons for that also. We fear cancer but not heart disease. Cancer is less likely, much less likely than heart disease. Heart disease is much more common, and you can take many steps to prevent it, but people are deadly afraid of cancer. It's very painful. And heart disease is no problem. People eat foods and don't do exercise, which is all. People say that there should not be any polluting activity done by others which will cause me harm, but there are no problems if they do this activity themselves. I don't know what the logic of this is, but not feel enough. So there is, all of these things are explained in the article, and there is now a literature coming up on systematic biases in human decisions, and these biases we are subject to. So how we should change our ways of thinking to improve our decision making. Now this is not part of economic theory, because economic theory always assumes that you automatically know how to do optimal behavior. So some of these biases are very important, and some of these are very important in the sense that people routinely make wrong decisions, like when you have a people routinely make decisions to overeat and not worry about their health. So at any particular time, the option to exercise is not going to improve your health immediately. So it's a long run prospect. So people go for the short run, narrow framing, and they don't think about the long run effects of something. So it is true actually that if you eat one slice of cake, it's not going to have any effect on the long run. It's just if you keep eating that slice of cake, that's going to have a major effect. And similarly, if you skip exercise today, but you do it tomorrow, it's not going to have a major effect. But if you keep doing exercise every day, then your health is going to be adversely affected. So this is what we do. We do narrow framing. Okay, today I will just have this fantastic biryani, and tomorrow I will diet. And so that tomorrow never comes. So that is how narrow framing, Ross aversion, these are the biases. If we know about these biases, we can try to overcome them. So this, for example, this is a real issue, that the stock market versus the bonds. People are putting money into retirement funds, and they put them into the bonds, and so they end up making $1,000 when it could have been $1 million. And so when you and also if you are in stocks, then the thing to do is to forget about it and put the money in and look at it 5 years later, rather than every day you're looking, and then some days it's up, some days it's down, you have a heart attack. And so it is a very variable in the short run, and if you make short run decisions, you will lose in the stock market. So many of these things matter a lot.